Most traders never learn the one number that separates professionals from amateurs. While you're chasing 500% returns and dreaming of overnight fortunes, professionals obsess over a different figure entirely. 2%. That's the maximum they risk on any single position. Ever. Here's the brutal truth that will save your trading career. 90% of retail traders blow up their accounts within 6 months. They risk 10%, 20%, sometimes 50% of their capital on a single sure thing. They confuse gambling with speculation. They mistake hope for strategy. The professional operator thinks differently. He thinks like an insurance company, not a lottery player. The mathematics are unforgiving. When you risk only 2% per trade, you can afford to be wrong 20 times in a row and still have 67% of your capital intact. Try that math with 10% risk per trade. You're broke after 7 consecutive losses. The amateur sees 2% risk as cowardly. The professional sees it as the foundation of all profitable speculation. Picture 2 traders last month. Ben took 27 trades, red every Friday, down 8%. Lisa took 4 trades, 2 scratches, 1 small loss, 1 runner that paid for the month, up 3.2%. Same market, different identity. Lisa waited for confirmation, sized small, set logical stops. She behaved like a market operator. Let me paint this picture more vividly. Ben started each Monday scanning for momentum plays, his eyes lighting up at every gap up and breakout alert. He'd risk $5,000 on his $50,000 account chasing a biotech stock because the chart looked explosive. When it dropped 12% by noon, he'd double down with another $4,000 because it has to bounce back. By Friday's close, he was nursing another $3,500 loss. His trading journal became a graveyard of hope and mathematical destruction. Lisa operated from an entirely different playbook. She spent Sunday evenings studying weekly charts, marking key resistance levels, noting upcoming catalysts. Monday through Wednesday, she watched, she waited. She let dozens of opportunities pass that failed to meet her strict criteria. When NVDA finally broke above its 21-day moving average with expanding volume on Thursday, she calculated her position size with surgical precision. $20,000 account, 2% risk equals $400 maximum loss. With a $2 stop distance, she bought exactly 200 shares, not 300 because she felt confident, not 500 because the setup looked perfect, exactly 200 shares because the mathematics demanded it. This is where the insurance company mentality reveals its power. State Farm doesn't bet the company on whether your house burns down this year. They spread risk across millions of policies, charge appropriate premiums based on probability, and let the law of large numbers compound their edge over time. Professional traders operate identically. They spread risk across many positions, size appropriately for each setup stop distance, and let their disciplined process compound over hundreds of trades. The psychological transformation runs deeper than most realize. When you risk 10% per trade, every tick against you feels like a personal attack on your intelligence. Your heart rate spikes with each red candle. Your palms sweat as unrealized losses mount. You start making decisions based on pain avoidance rather than probability assessment. You become reactive instead of proactive, transforming from a market operator into a market victim. But when you risk only 2%, something profound shifts in your trading psychology. The individual trade becomes just another data point in your probability distribution. You can think clearly because your financial survival isn't tied to any single outcome. You can hold through normal market volatility because your stop placement respects technical levels, not emotional comfort zones. You can add to winners systematically because you have capital preserved from properly managed losers. Consider this revealing scenario. Stock breaks out of a 6-month consolidation pattern at $48. The logical stop sits at $44, just below the breakout level where the technical pattern would be invalidated. Amateur trader examines this setup and recoils. $4 downside? That's too much risk for one position. He either passes on a high probability setup entirely or sets his stop at $46.50 to limit his risk. Professional operator sees the identical setup and calculates $4 stop distance on a $100,000 account means 625 shares to risk exactly 2.5% of capital. He takes the trade with complete confidence because the mathematics work in his favor over time. 3 trading sessions later, normal profit-taking pressure hits the stock at $46.75. The amateur's artificially tight stop gets triggered for an $875 loss. He watches in frustration as the stock recovers to $52 the following week. The professional holds through the temporary noise because his stop placement respected the market's structural logic rather than his emotional comfort. His $2,500 risk transforms into a $2,500 profit as the breakout thesis plays out exactly as anticipated. Here's the position sizing formula that removes emotion from the equation. Shares equals account size times risk percentage divided by stop distance. If your $50,000 account risks 2% or $1,000, and your entry is $40 with a $37.50 stop, the distance is $2.50. So you buy exactly 400 shares, not 700, because the CEO sounded convincing on the earnings call, not 1,200 because your research indicates massive upside potential, 400 shares because the mathematics demand it. This formula also exposes flawed thinking. If your planned stop is only $0.20 away to keep losses small, you'll either end up oversizing dangerously or getting whipsawed by normal market noise. The 2% rule creates what professionals call active patience. You're not passive or indecisive. You're actively waiting for the precise conditions where probability tilts decisively in your favor. This patience becomes your position. While amateurs chase every headline and momentum surge, you're preserving capital for the setups that truly matter. Survival creates options. Options create opportunity. Survival capital. Opportunity funds the compounding that builds lasting wealth. But here's what most traders miss about the 2% rule. It's not just about position sizing. It's about rewiring your entire relationship with uncertainty. When you can only lose 2% on any trade, you stop hoping and start thinking. You transform from a gambler into an operator. The next principle builds on this foundation, but it requires abandoning everything you think you know about limiting risk. Here's where most traders get it backwards. They set tight stops to limit risk and wonder why they get chopped to pieces. The amateur places his stop based on how much he's willing to lose. The professional places his stop based on where the market tells him he's wrong. Stock breaks out of a 6-month base at $50. Amateur trader buys 100 shares, sets his stop at $49 because I don't want to lose more than $100. Professional operator buys the same breakout but sets his stop at $47.50, just below the breakout level where the take pattern fails. Same stock, different thinking. 3 days later, normal profit-taking hits $48.75. The amateur gets stopped out for his $125 loss. The professional holds because the technical structure remains intact. 2 weeks later, $58. The amateur limited his risk right into a missed opportunity. The professional understood that meaningful moves require meaningful risk. This is the stop-loss paradox. Trying to minimize risk often maximizes it. When you set stops based on comfort rather than market logic, you guarantee death by 1,000 paper cuts. You'll pick winning stocks but lose money consistently. You'll be right about direction but wrong about execution. Let me dissect this psychological trap that destroys more accounts than bad stock selection. The amateur approaches stop placement like ordering at a restaurant, deciding what he's comfortable paying before examining what the market is actually serving. I can afford to lose $200 on this trade, he announces, then reverse engineers his position size and stop level to fit this arbitrary comfort zone. This treats the market like a vending machine where you insert your desired risk amount and expect predictable outcomes. The professional operator thinks completely differently. He studies the stock's technical structure, like a surgeon examining X-rays before the first incision. Where did the stock break out? What price level would invalidate the bullish thesis? Where do other traders have their stops clustered? He places his stop where being wrong becomes mathematically certain, not where being wrong becomes emotionally comfortable. Consider NVDA consolidating between $420 and $440 for 6 weeks, building energy like a coiled spring. Volume contracts during consolidation, indicating selling pressure has been absorbed. The stock finally breaks above $440 on expanding volume, with a decisive close at $443. Amateur trader gets excited and buys 50 shares, but he's only comfortable risking $400, so he sets his stop at $435. His logic: if it drops to $435, I'll lose exactly $400 and move on. Professional operator examines the identical setup, but thinks structurally. The breakout occurred at $440. For this bullish thesis to be invalidated, the stock would need to fail back below the breakout level with conviction. He sets his stop at $437, giving the breakout room to breathe while protecting against genuine pattern failure. With his $100,000 account risking 2%, he calculates $2,000 divided by $6 stop distance equals 333 shares. 2 sessions later, normal consolidation pressure hits NVDA at $436.50. The amateur's artificially tight stop triggers automatically. He watches his position get stopped out for exactly his planned $400 loss. But this risk control cost him participation in a legitimate breakout. The professional holds comfortably because his stop placement respected market structure. 1 week later, NVDA gaps to $465 on strong earnings guidance. The amateur sits on sidelines. The professional books a $9,324 profit. Here's the mathematical devastation of comfort-based stops. Let's say you identify 12 legitimate breakout setups over 6 months. Your analysis is sound. 8 of these stocks eventually move 20–30% higher after breaking out, but your comfort-based stops get you chopped out of 6 positions during normal consolidation phases. You participate in only 2 winning moves while taking 10 small losses. Despite being right about 67% of your stock picks, you end the period down 8% because execution sabotaged analysis. Professional operators avoid this through structural stop placement. They identify the specific price level where their investment thesis becomes invalid, then work backwards to determine appropriate position size. If a momentum stock breaks above key resistance at $42, the logical stop sits just below that level at $41.25, not at $41.75, because you're comfortable losing $500, not at $41 because you want extra room, at $41.25, because that's where the technical pattern fails and your thesis gets invalidated by market action. This requires abandoning the illusion of control that comfort-based stops provide. You cannot dictate how much the market is allowed to move against you before proving you wrong. The market operates according to its own volatility characteristics. Your job is to respect these characteristics while positioning appropriately for probabilities, not impose your comfort zone on market reality. Protocol for structural stop placement. First, define the pivotal point that matters, the level that, if broken, negates your premise. Second, measure recent volatility using average true range over 14 periods. Third, place your stop 1.5 to 2 times that ATR distance beyond the pivotal point to account for normal market noise. Fourth, calculate position size so the dollar loss at that stop equals 2% or less of your account. If the required size feels small, excellent. Your ego isn't your risk manager. The 2% rule solves this elegantly. When you're only risking 2% of capital, you can afford to give positions proper room to breathe. You can set stops where they make technical sense, not emotional sense. If the logical stop is $4 away instead of $2, you simply adjust position size accordingly. Total risk remains constant at 2%, but stop placement respects market structure rather than personal comfort. Consider different market environments. In trending markets, use previous swing lows as stop levels for long positions. In range-bound markets, place stops just outside established support and resistance zones. For breakout trades, stops belong just below the breakout level where the pattern would be invalidated. For earnings plays, account for increased volatility by widening stops appropriately while reducing position size to maintain 2% total risk. Here's a counterintuitive truth. Wider, logic-based stops often reduce risk if they prevent re-entry churn. Death by 1,000 cuts isn't conservative. It's compounding slippage, fees, and frustration. The amateur who gets stopped out 3 times at small losses, then chases the stock higher and gets stopped out again, has taken 4 times his intended risk while missing the actual move. Use hard stops, not mental ones. Platform freezes, gaps, and hesitation happen fast. Pre-place your stop order immediately after entry, then step away for 15 minutes. This delay interrupts the urge to tinker and gives the market time to reveal whether your read was accurate. If you get stopped out, treat it as confirmation that your risk plan worked. You paid a small premium to avoid large disaster. Some trades deserve time stops as well as price stops. If a breakout doesn't advance within 2 to 3 sessions, consider cutting or tightening. Momentum that fails to confirm is information. Professionals catalog that information and redeploy risk. Amateurs defend stale ideas with hope. The amateur celebrates getting stopped out quickly because it feels disciplined, yet never asks whether the stop lived in noise or logic. The professional celebrates both the discipline of proper stop placement and the discipline to honor it when hit. That second discipline separates theory from money, but proper stop placement is worthless without the discipline to honor them when hit. That's where the next principle separates operators from gamblers. This is where the 2% mindset becomes pure arithmetic. Most traders blow up not from bad picks, but from bad size. The problem: you size to your ego, not your risk. You add to losers because it must come back. Then you meet math you cannot negotiate. Maya turned $50,000 into $63,000, catching a clean tech trend. Then she gave back $19,000 in 3 weeks. Why? She risked 4 to 5% per trade and averaged down twice when wrong. One gap down morning, her stop became a prayer. A professional would have done the opposite. Risk less, cut faster, add only to strength. Let me dissect Maya's destruction in mathematical detail, because her story represents thousands of accounts that self-destruct through ego-driven sizing. February started beautifully. She caught TSLA at $185, NVDA at $420, and AAPL at $175 with disciplined $2,500. Positions representing exactly 5% of her account. Each position moved 15–20% in her favor over 6 weeks. But success bred overconfidence, and overconfidence bred catastrophic oversizing. March arrived with Maya feeling invincible. She spotted ROCU breaking above $65 resistance and decided this would be her home run trade. Instead of her usual position size, she allocated $5,000, exactly 10% of her account. Her reasoning: I've been right 6 times straight. This setup is cleaner than the others. When ROCU dropped to $62 the next day, she didn't honor her planned stop. She averaged down with another $3,000 at $61.50, because streaming is the future, and this weakness is temporary. The gap down arrived March 15th. ROCU opened at $56.50 on disappointing subscriber guidance. Maya's combined $8,000 position became worth $4,520 in 30 seconds. Her carefully planned $325 stop loss had transformed into a $3,480 nightmare. But the mathematical damage ran deeper than one catastrophic trade. She had violated every principle that built her initial success. Professional operators understand position sizing as the difference between surviving temporary setbacks and experiencing permanent capital destruction. When you risk 1% per trade, you can sustain 50 consecutive losses and retain half your capital. The mathematics work in your favor over hundreds of trades. When you risk 5% per trade, 7 consecutive losses reduce your account by 30%, creating a psychological and mathematical crater that becomes nearly impossible to escape. Protocol: risk 0.5 to 1% per trade. Cap total risk per idea at 2%, including all planned additions. Daily loss limit, 2%. Weekly loss limit, 4%. If you hit a limit, stop trading. The mathematics are beautiful for professionals, brutal for amateurs. With 45% win rate and 2-to-1 reward to risk, risking 1% keeps you alive through inevitable noise. Size by stop distance. Shares equals account times risk percent, divided by entry, stop. If your $100,000 account risks 1% $1,000, and your stop is $2 away, you buy 500 shares. If the size feels too small, your stop is too tight, or your ego is too loud, this formula exposes flawed thinking immediately. If your calculated position size feels disappointingly small, you face two problems. Either your stop placement ignores normal market volatility, or your ego demands more action than your capital can mathematically support. Both problems systematically destroy accounts. The solution isn't larger positions, it's better setups or larger accounts built through proper compounding. Consider two traders with identical $50,000 accounts facing identical conditions over 6 months. Amateur trader risks 5% per position, seeking meaningful returns from each trade. Professional operator risks 1% per position, seeking consistent execution of proven process. Both identify the same 10 high-probability setups. Both experience identical 60% win rates, with similar average gains and losses per winning and losing position. The amateur's results: 6 winners averaging 18% gains, 4 losers averaging 12% losses. His mathematics: 6 times 18% times 5%. Risk equals plus 5.4% from winners. 4 times 12% times 5% risk equals negative 2.4% from losers. Net result: plus 3% return, ending at $51,500. Seems reasonable until you examine the psychological carnage. Each 12% loss on a 5% position cost him $3,000. The stress from these losses triggered revenge trading, position size increases, and eventually a catastrophic 25% drawdown requiring months to recover. The professional's identical results: same 6 winners, same 4 losers, identical percentages. His mathematics: 6 times 18% times 1%, risk equals plus 1.08% from winners. 4 times 12% times 1%, risk equals negative 0.48% from losers. Net result: plus 0.6% return, ending at $50,300. Lower absolute return but zero psychological damage. Each loss cost only $600, easily absorbed without emotional trauma. This stability allowed him to execute 17 additional setups the amateur missed due to hesitation and recovery periods. Risk aggregation destroys accounts quietly. You think you're diversified buying 5 different tickers. But if 4 are semiconductors breaking out on identical macro catalysts, you don't have 5 independent ideas. You have one idea expressed 5 times. Professionals cap total correlated exposure. If semiconductors represent one thesis, the sum of all related positions cannot exceed 2% total account risk. If you're risking 0.75% per individual name, you can hold maximum 2 semiconductor positions simultaneously, not 6. Daily and weekly loss limits provide crucial circuit breakers. When you hit your 2% daily loss limit, close your platform and walk away. Your emotional state has been compromised. Your decision-making is impaired. Continuing to trade transforms speculation into gambling. Professional operators treat these limits as mathematical requirements, not suggestions. They understand preserving capital today creates opportunities tomorrow. Weekly loss limits serve different purposes. A 4% weekly drawdown indicates either unusual market conditions or flawed execution. Either scenario requires stepping back for analysis to prevent small problems from becoming account-threatening disasters. The mathematics are unforgiving. A 6% drawdown requires 6.38% gains just to break even. A 10% hold demands 11.1% recovery. Drawdowns widen non-linearly. The deeper you dig, the harder escape becomes. Here's the pattern interrupt. Close your platform for 15 minutes after placing each trade. Let the plan work. Size is your seatbelt, but a seatbelt without brakes isn't safety. The next principle reveals why most traders who master risk still fail to capture the big moves. The mathematics of ego manifest most destructively in averaging down on losing positions. Amateur logic. If I liked it at $50, I should love it at $45. Professional logic. The market is telling me I was wrong at $50. Why would I compound my error at $45? Averaging down transforms manageable losses into account-threatening disasters. The only time professionals add to positions is when they're moving in the intended direction with confirmed strength and volume expansion. Position sizing determines your psychological relationship with individual trades. When you risk 1% per position, no single trade can materially impact your financial future. This removes the emotional attachment that leads to poor decisions. You can cut losses quickly because each loss represents just another data point in your probability distribution. You can hold winners longer because you're not desperately hoping for profits to validate your intelligence. Professional operators view position sizing as their primary edge over amateur participants. Superior analysis means nothing if position sizing sabotages execution. Perfect timing becomes irrelevant if ego-based sizing creates unsustainable risk exposure. Consistent profits require consistent process, and consistent process demands mathematical discipline in position sizing decisions. The amateur celebrates tight risk management, while unconsciously violating it through position size creep. The professional celebrates boring, systematic execution that compounds edge over hundreds of trades. Your tools matter less than your discipline, but tools help enforce discipline. Use position sizing calculators that populate shares automatically from entry and stop prices. Set alerts at 50% and 80% of daily loss limits. Log decision states heart rate, distractions, sleep quality because poor sizing correlates with poor conditions. Think in sequences, not single outcomes. A 40% win rate with 3-to-1 reward to risk often outperforms 60% win rate with 1-to-1 ratios because variance favors fixed risk with asymmetric outcomes. Ego hates low hit rates because it wants validation today. Mathematics loves them because they keep you solvent tomorrow while building systematic edge. Here's the problem with perfect risk management. When you finally catch a winner, most traders don't know what to do with it. They take profits too early or let winners turn into losers. The amateur celebrates a 20% gain and sells. The professional sees 20% as potential confirmation to add more. This is pyramiding, adding to proven winners at higher prices with reduced position sizes. It's the opposite of what feels natural, but it's how market operators build generational wealth from individual positions. You've mastered the 2% rule that keeps you alive. You've learned to place stops where the market proves you wrong, not where your comfort zone dictates. You size positions mathematically, removing ego from the equation. These foundations create survival. But survival alone doesn't build fortunes, it creates the platform for capturing them. The next step transforms small gains into account-defining winners through systematic exploitation of validated market strength. Watch this progression. Professional buys 1,000 shares at $50, risking 1% with a $49 stop. Stock moves to $55, confirming his thesis with expanding volume and clean price action. He adds 500 shares at $55, moving his stop to $52 to protect profits. Stock continues to $62 with sustained momentum. He adds 250 shares at $62, adjusting stop to $58. When the move completes at $70, his mathematics look like this. Initial position, 1,000 shares times $50 equals $50,000. First edition, 50 shares, 50 septini, 50. Second edition, 250 shares, 50. Total investment, $93,000 across 1,750 shares. Average cost, $93. 0.000除以1750等于53美元14美分 per share exit value 1 750 shares keer $70 is gelijk aan $122,5 total profit $122,500 $93,000 equals $29,500. The amateur bought 1,000 shares at $50, sold at $55 for $5,000 profit. He watched it reach $70. He made $5,000. The professional made $29,500 using the same initial capital allocation and identical risk management principles. Same market, different identity. Same opportunity, different execution. Let me dissect the psychological warfare occurring in both traders' minds during this progression. The amateur experiences the familiar cycle of fear and regret. He bought at $50, watched the stock climb to $55, and felt the overwhelming urge to lock in profits. His brain screamed warnings. Take it now before it disappears. He sold, felt temporary vindication, then watched in agony as the stock continued to $62, then $70. Each tick higher became a personal attack on his intelligence. I could have made $20,000 instead of $5,000. His inner voice tormented. The professional operator experiences entirely different psychological pressures. Adding at higher prices violates every amateur instinct about buying low. His average cost rises with each addition, making him feel like he's chasing rather than leading. When the stock briefly dips to $59 after his $62 addition, his unrealized loss temporarily exceeds $3,000, but his stop discipline and profit protection keep him focused on probabilities rather than emotions. He understands that meaningful moves require meaningful commitment, but only when the market validates that commitment through objective confirmation. Each ad requires fresh confirmation, volume, momentum, clean tape action. Each ad is smaller than the last. Stops always protect accumulated profits. This isn't gambling, it's following strength with strength while the market validates your thesis. The confirmation criteria must be objective and mechanical. Volume should expand 40% or more above the 20-day average on each leg higher, indicating institutional participation rather than retail speculation. Price action should show orderly advancement, higher highs and higher lows, without excessive gaps or parabolic moves that signal exhaustion. Momentum oscillators should remain in bullish territory without reaching extreme overbought conditions that precede corrections. Professional operators monitor what they call tape quality, the character of trading around their positions. Clean tape shows steady buying with minimal volatility, patient and informed buyers, sellers taking profits systematically rather than panicking. Dirty tape reveals erratic price swings, emotional buying and selling, and the kind of speculation that often precedes reversals. No clean tape, no addition, no exceptions. The position sizing follows mathematical precision, using what professionals call the inverted pyramid structure. If your initial position represents 1% account risk, structure your additions as 603010 or 503020 percentages of your planned maximum position size. This ensures that later additions, made at higher prices, represent smaller absolute share quantities that won't devastate your average cost if the move reverses. Protocol for systematic pyramiding. Risk per idea capped at 2% total across all additions. Each ad risks a fraction of remaining capacity under this ceiling. Stops ratchet higher to protect accumulated gains. They never move down, never widen to give room, only advance as proof accumulates. You're building a staircase of controlled risk where each step up protects the gains from previous steps. Consider the timing framework professionals use. The 1R ladder provides objective entry points for additions. R represents your initial risk per share. If your first entry at $50 with a $49 stop risks $1 per share, consider adding after the stock moves 1R to $51 and consolidates constructively above that level. A second addition might come after 2R movement to $52 with a tight flag pattern that holds above the prior breakout level. Every addition must be justified by structural confirmation, not emotional conviction. Here's the counterintuitive truth about pyramiding. It often reduces risk while increasing profit potential. Your initial position establishes the maximum loss you're willing to accept. Each subsequent addition is made at higher prices with stops that protect existing profits. Even if the final addition gets stopped out immediately, you've still captured significant gains from earlier positions. The amateur who sells everything at the first sign of profit has zero protection against missing major moves. Stop management becomes crucial as positions expand. After the first addition, raise your stop to just below the last pivot low or the 21-day moving average, whichever provides logical support while protecting profits. After the second addition, trail beneath the next higher low or beneath a rising 10-day exponential moving average for swing trades. Your stop structure. You should respect the stock's volatility characteristics. If the stock typically experiences 3 to 5% pullbacks during uptrends, accommodate this normal behavior rather than get triggered by routine consolidation. The mathematics create compounding effects that amateur traders never experience. Consider Sarah, a growth stock specialist who missed 5 significant moves last year by selling too early. She adopted a systematic pyramiding checklist. Entry on breakout above base with 2 times volume, risk 1%. Addition 1 after reclaim of prior high following tight 3-day flag. Add 0.6% risk. Move stop under flag low. Addition 2 on new high with accelerating relative strength and sector leadership. Add 0.4% risk. Trail under 10-day EMA. Result: she compounded one solar energy trend into a 28% account gain while taking 6 small scratches elsewhere, totaling negative 3.2%. One runner funded her entire quarter because she learned to step on the gas only when the road was clear. But respect, context, and avoid pyramiding into exhaustion. Don't add when average true range balloons 60% in 3 sessions, and candlesticks widen dramatically. You're late in the swing. If the tape shows heavy upper wicks, failed breakouts in peer names, or negative divergence in market breadth, your addition becomes a donation to volatility. Wait. Doing nothing is sometimes the best trade. Waiting is a position that pays dividends through preserved capital and better opportunities. Use sector and relative strength analysis to validate additions. Check that the relative strength line hits new highs, confirming leadership. Verify positive sector flow if the group lags while your stock advances. Hidden correlation risk may sabotage your pyramid when sector rotation occurs. The tape should show bids stepping up on dips, not disappearing. Intraday, use VWAP reclaims and higher low sequences to time precise entry points for additions. Set hard risk ceilings to prevent position size from overwhelming your account. Total heat on the entire pyramid never exceeds 2% for swing trades built off daily charts, 3% for position trades constructed from weekly patterns. If your stop structure requires more room than these limits allow, either your sizing is wrong or your setup lacks sufficient quality. Cut the position, reassess the structure, and wait for better architecture. Here's a story that illustrates the identity transformation required. Tom caught a clean payment stock breakout at $32, sold at $38 for 18% profit. 2 weeks later, earnings news sent it to $51. Then steady institutional accumulation carried it to $74 over 3 months. Tom swore he'd never sell early again. His next trade, he held without stops, without additions, watched a 25% gain turn into a scratch as the stock round-tripped. His lesson was backwards. The goal isn't never sell early. It's sell when structure breaks, add when structure confirms. Professionals don't marry positions. They date trends. They leave when behavior changes. Commit when behavior improves. Fear and greed attempt to hijack pyramiding decisions. Fear whispers, "Don't add. You'll give back profits." Greed shouts, "Add. Huge. This is the one." The professional answers both with mathematics and predetermined rules. I will add the calculated amount at predefined levels, and I will raise my stop to protect prior profits. No speeches, no predictions, just systematic execution of proven protocols. The amateur needs profits now. He sells the first glimpse of green because fear whispers that gains will vanish. The professional needs process now he holds because his stop hasn't triggered and trend structure remains intact. He adds because the market offered objective confirmation through volume, momentum, and clean price action. He isn't greedy. He's obedient to proof. He understands that one campaign can define his year, that one runner pays for 20 scratches. Maxim, don't be right often, be right big. This captures the essence of asymmetric returns that separate wealth builders from paycheck traders. You can maintain a 45% win rate, yet generate substantial profits if your average winner significantly exceeds your average loser. Pyramiding ensures that when you are right, you capture a disproportionate share of the market's biggest moves, rather than settling for small, consistent gains that never compound into meaningful wealth. But pyramiding only works if you can overcome the most seductive myth in all of trading. The myth that destroys more accounts than bad analysis, poor timing, or inadequate capital combined. It's the belief that whispers promises of certainty and control, yet inevitably leads to hesitation, missed opportunities, and smaller profits. It's the need to be right about every decision, the craving for vindication, the demands of ego. The next principle reveals why this need to be right becomes the most dangerous enemy of profit, and how professional operators replace it with something far more powerful. The most dangerous myth in trading isn't about money management or technical analysis. It's about being right. Amateurs need to be right. Professionals need to be profitable. This difference determines everything else. Here's what kills more accounts than bad entries: the need to prove you're smart. Amateur buys stock at $40, watches it drop to $35, holds because I know I'm right about this company. He's confusing being right about a business with being right about a trade. Professional buys the same stock, sees it hit his $37 stop, exits immediately. He doesn't need vindication. He needs capital preservation. The mathematics are unforgiving. Lose 10%, you need 11% to break even. Lose 20%, you need 25%. Lose 50%, you need 100%. The amateur who knows he's right and refuses his 7% loss often ends down 30%, creating a mathematical hole that becomes nearly impossible to escape. Let me show you this psychological trap in action. David, a software engineer, spent 40 hours analyzing TSLA fundamentals. His models showed fair value at $280. When TSLA hit $275, he bought 200 shares with complete confidence. His stop: I don't need one. The math proves I'm right. 2 weeks later, TSLA traded at $245 on disappointing delivery numbers. David's response: the market is wrong. This is temporary noise. He held. At $220, he doubled down. At $195, he added again. His $55,000 investment became worth $34,200. Professional operator Sarah examined identical TSLA fundamentals, equally compelling analysis, identical entry at $275, but she placed her stop at $260. Not because she doubted her research, but because she understood the difference between being right about a company and being right about trade timing. When TSLA hit her stop, she exited with a $3,000 loss. No drama, no attachment to vindication. 4 months later, TSLA bottomed at $180 and recovered to $320. David sold at $210 for a $28,800 loss after 6 months of agony. Sarah deployed. Her preserved $47,000 across 8 trades during that period, generating $11,400 profits. Same analysis, different psychology, opposite outcomes. But here's the deeper insight. Being wrong quickly is more profitable than being right slowly. Professional operators celebrate fast losses because they preserve capital for better opportunities. Being wrong is tuition. Being wrong and staying wrong is bankruptcy. The mathematics of recovery expose why ego becomes financial suicide. Lose 10%, you need 11.11% to break even. The relationship accelerates viciously. Lose 30%, you need 42.86%. Lose 50%, you need 100% gains just to return to break even. This isn't motivational math, it's a cliff. Every time you defend a loser to avoid admitting error, you step closer to that edge. The need to be right transforms trading from business into emotional warfare. When your ego is attached to trade outcomes, every red position feels like a personal attack on your intelligence. You start making decisions based on ego protection rather than profit optimization. You hold losers to avoid admitting error and sell winners to validate brilliance. This cycle guarantees mediocrity because it prioritizes feelings over mathematics. When you need to be profitable instead of right, individual trades become data points in a probability distribution. You expect to be wrong 40–60% of the time because that's normal in probabilistic endeavors. You celebrate quick losses because they preserve capital for better setups. You hold winners longer because ego isn't attached to immediate vindication. The identity shift requires abandoning deeply held beliefs about intelligence and success. First, accept that being smart doesn't guarantee trading profits. The market rewards behavioral discipline, not analytical brilliance. Second, embrace uncertainty as permanent rather than temporary. Third, measure success by process execution, not individual outcomes. Fourth, treat losses as information, not failure. Professional operators develop what psychologists call intellectual humility, recognizing that knowledge has limits and markets can teach you things analysis missed. This manifests practically. Predetermined stops that respect market structure over personal opinion. Position sizing that assumes you might be wrong. Systematic profit-taking that captures gains before markets change their minds. Protocol for transformation. Predetermine maximum acceptable loss before entering positions. Write your thesis in specific invalidation conditions. Set alerts for those levels rather than constantly monitoring. When invalidation occurs, exit immediately without negotiation. Practice celebrating fast losses in real time. When stopped out quickly, say, "Excellent risk management," instead of "Damn, I was probably right." The amateur's internal dialogue during losses. "This is temporary. I did my research. The market will realize I'm right eventually." The professional's dialogue. "The market is telling me something I missed. I'll take this small loss and redeploy capital where probability looks better." Here's the compounding effect over time. Amateur needs to be right, holds losers, cuts winners, generates 35% win rate with negative expectancy. Professional needs to be profitable, cuts losers, holds winners, generates 45% win rate with positive expectancy. Same market, different psychology, dramatically different results. This connects everything we've covered. The 2% rule makes being wrong affordable. Any single loss becomes a minor bump, not catastrophic crash. Proper stops make being wrong quick, cutting losses before they become emotionally debilitating. Patience makes being wrong rare, by waiting for confirmed setups. Pyramiding makes being right incredibly profitable by maximizing gains on validated moves. But none of it works if you need to be right more than you need to make money. The transformation isn't immediate. Your ego will resist every loss, every admission of error, every trade that challenges your intelligence. But each time you choose profitability over being right, you strengthen neural pathways that separate successful operators from the 90% who fail. You're rewiring your brain for probabilistic thinking instead of binary right-wrong thinking. Consider the mental overhead of holding losing positions. It consumes focus, drains energy, distorts judgment on other opportunities. You might miss fantastic breakouts because attention is fixated on dying embers of bad trades, desperately hoping for miraculous recovery. Professionals free themselves from this burden. Once stops hit, trades are over mentally and financially. They clear minds, review lessons, prepare for next opportunities with fresh eyes and preserved capital. Your edge isn't superior analysis. It's superior psychology. Cut losses fast, size small, wait for confirmation, pyramid from strength, own your process. The market doesn't care about your intelligence or ego. It only responds to supply and demand, ruthlessly exploiting emotional vulnerabilities. Before every trade, ask yourself, do I need to be right about this position or profitable from this process? If the answer is right, step away until psychology shifts. If profitable, execute with mathematical precision and psychological detachment. The amateur studies companies and predicts prices. The professional studies probabilities and manages risk. The amateur needs market validation of intelligence. The professional needs systematic profit extraction opportunities. These represent completely different approaches to uncertainty, risk, and success. Your long-term equity curve mirrors not just your method, but your maturity. Are drawdowns shallow and orderly, or sudden and catastrophic? Do you bounce back because risk stayed contained, or stall because you defended pride? Professionals engineer survivability first, growth second. Amateurs attempt growth first, survivability never. Final protocol: cut losses fast, size small, wait for confirmation, pyramid from strength, own your process. These aren't slogans, they're shock absorbers that turn drawdowns into scratches, scratches into opportunities, opportunities into compounding. The market will teach you everything about the difference between being right and being profitable. If you mastered this foundation, the next lesson on reading market psychology will deepen your operator's edge, showing how to recognize when other participants are trapped by the same myths that once controlled your decisions.